Going to talk with a 12-year Wall Street veteran about an interesting call for Mr. Tom Lee at Fundstrat. He actually said this morning that 6,600 is more likely today than last week. Taylor, put this in context for us. What does a 6,600 on the S&P mean? Tell us a little bit about Tom Lee, and just wow, he is all over CNBC saying we're going higher.
Yeah, so Tom Lee is a perma bull to start. He is always bullish, and not for nothing, but it's been the right call. Like being bullish,
he's been right a lot.
Very hard to argue with him. But he can look stupid in the short term. He looked a little silly in 2022 at times when the market gapped downwards, et cetera. 6,600 from a move right now. We're at about 5,900 on the S&P 500. So that's about a 12% gain from where we're at. And for the record, to Tom's credit, he did not come off of his initial forecast for the year, which was 6,600, even when the market gapped down massively. And at that point was down 16.5% for the year. Now it's back to positive 1 to 2%, somewhere in that ballpark. And now he's saying a 12% run from here, which would close the year out at 14% or so.
You know what? I really respect Tom Lee because, again, he could have very easily come in after Liberation Day. And again, to your point, he looked pretty foolish because, he was caught off guard like all of us, just how bad Liberation Day was. But I love the fact that he never changed his opinion because it would have been so easy to just put out a new number.
Everyone else did.
Yeah, I respect that. As somebody who personally makes bold calls and doesn't change very often, I'm going to give him credit for sticking with 6,600. And he's frankly looks more right today than he did last week.
Totally.
But I just don't get it. Right. You shared in past videos, folks, check out the playlist, where, a 6,600 means one of two things. Either earnings have to grow or the multiple has to expand. And we already have pretty stretched on both of those fronts historically. So, I mean, how does the math work to get up 12% from here?
It's hard to do. It is very hard to do.
Great.
At the beginning of this year, I think the argument could have been corporate profits continue to expand. I think that is a Swiss cheese argument right now, just with the fact that tariffs have completely thrown off global supply chains. People don't know where to order their goods from. Apple's trying to circumvent the tariff policy by moving to India from China. Trump says no way. It's just you're trying to sail a ship right now, and Hurricane Katrina is coming your way. And it's just, you don't know what to do from a CEO perspective. So what they do is largely sit on their hands. They continue to spend on areas where they believe they know there's profitability to come in the future. AI is where everyone's spending money right now. And that spending has been exorbitant even through Q1. And I would anticipate it continues to be in Q2. But everywhere else, people are kind of batting down the hatches on spending and saying, we got to be more conservative right now because we just don't know the rules of the game.
When you look at an S&P 500 at 6,600, again, I don't know how that's made up of the industries and whatnot, but it just feels like, some of the legs are already richly valued. AI, right? Chip stocks. Could they go higher? Sure, but how much higher? Mm-hmm. But then you also have all these consumer discretionary that have to be weakening, right? Whether it's airlines or retail goods or whatnot. I mean, the most impressive number I saw in the economic data series last week was personal savings rate. And the fact that the U.S. consumer's personal savings rate went from sub 1 to almost 5 in a month screams the consumer's not spending. So I just don't get it.
Agreed. And then you put the backdrop of a higher debt burden. And so all of a sudden now and when I talk about debt burden, I mean countries' debt burden of the United States. And so all of a sudden you have this headwind. When you have a higher debt burden, like let's be clear on what this means. That is just a parachute out of the back because more government spending that could be used on appropriating goods to XYZ that are in need, et cetera, goes to servicing the debt. So all of a sudden you get this massive reduction in government spending towards purposeful things that drive an economy to now, instead, we're going to be funding our debt with this payment. And it's like putting, dollars in a vacuum and having them disappear.
Yeah. It's interesting when in the past conversation we talked about the chance that the Fed was going to raise rates versus lower its next move, and you thought it was a very low percentage. I'm curious if I were to ask you the chances of seeing 6,600 sometime this year. Does it just feel as unlikely, or do you think it's more? Do you see a path to 66?
No, more. I think the path to 6,600 is more likely than a rate hike.
Okay.
Let me be clear on that. But that is a 12% move, and so again, to the point you were making before, it's like it's really hard to see meaningful earnings expansion in this market because of what everything is, what every company and CEO are dealing with. But it's also equally hard to see margin expansion, and the margin expansion is just more indicative of like throughout history, there's only a handful of times where you can put your finger on and say valuations were more expensive right there. Valuations are simply a function of the level of jubilance. I'm not sure if that's a word, but the level of excitement in the market. And right now, although you ask someone, it doesn't feel like it. The valuations are jubilant. They're back to a point where only 7% of the time historically, valuations have been higher than they are currently today. The market is excited.
Now, you probably don't know this, but I'd appreciate a guess. So as of today, we're kind of on the set that 7% range have been higher. If we go up another 16% from here, which I think you highlighted, that's got to take us to what, 2% of the time? Something. It's got to be crazy.
Yeah, you're ballpark in there, but I would put the number in the same vein. And all of a sudden now you're like, okay, there's froth coming out of the mouth of a dog. Right?
Do you guys remember the .com craze? I do. That was wild.
So that's what it would take again, unless you can see earnings really start to ratchet higher. And it's hard to make the case for that. Markets can be very, very irrational in short terms.
Sure.
When you broaden it out and look at things more broadly, it becomes much more directional. JP Morgan has this phenomenal chart, and the chart shows, given a starting price to earnings multiple, what happens 1 year out. And it is a shotgun blast, meaning there's no rhyme or reason to the timing mechanism of valuation. It is not a good timing mechanism. You look at the 90s, there were 4 years in a row there where stock market was incredibly high priced and just got higher and higher priced, and stocks did incredibly well. You look at irrational exuberance, which is the great Alan Greenspan line. That was in 96. The market didn't implode until early 2000. So it was a period where things just got more and more proliferant. But when you back it out to a 5-year basis, there becomes a best fit line that is a regression where when stocks are really cheap, it is highly likely that over the next 5 years, the stock market does really well. When stocks are expensive, it is highly unlikely that when you average out the next 5 years worth of stock market returns, that they are anything to speak about. And right now where we sit at, the next 5 years on that chart looks somewhere in that 3 to 4% return ballpark.
Yeah, there's a lot of people that I'm starting to hear more and more people talk about what's called a lost decade. Maybe it's lost 5 years, where basically everything is just flat.
Yeah, I heard a great comment the other day. 4, 5, 6.
4, 5, 6.
4, 5, 6. 4% on cash, 5% on bonds, 6% on stocks for the next decade. And you look at that and you go, okay, that's you're still getting a return premium, a real return, I guess is what I'm saying there.
Yeah.
But the return premium that stocks are providing versus bonds or cash is just more muted. And that has to be the thought process as you look at the market backdrop and the valuations where we currently are. I think it becomes more and more compelling in the market right now to start to look to places in the private markets, whether it's private equity, private credit, private real assets, private infrastructure. Those areas of the market are just less easily bought, and therefore they can't get to the euphoric state as quickly as other assets can in the public market. Not every Tom, Dick, and Harry can buy them. And there's an argument to be made that that's not a good thing. And I understand that, because there are hurdles that don't allow the average investor to get into them. But at the same time, it also protects them from a euphoric state more so than public markets do.
Love that. Taylor, where can people find you?
Yeah, find us at LifeGoal Investments. We're on Instagram and TikTok daily.
Awesome, buddy. Thank you so much.